Well, today we have this honor to be hosting Mike McGlone, who is my great person to look up to in terms of the market analytics. So many times I've been seeing and actually honoring his tweets, his materials, his overall works as an amazing market analyst. And today, Mike is going to talk to us basically about the 2022 so far in terms of what's been cooking up in the markets, what we potentially may expect in 2023, knowing that there are some odds somewhere here and there potentially for some sort of like a soft landing or reversal. The recession is still, I should say, somewhere in the question mark. So we're going to solve this and crack this puzzle with Mike McGlone. How is it going, Mike? How are you feeling?
Well, hello, Adrian. I appreciate being on. I appreciate meeting you, in particular our connection with your Polish background. I'm Lithuanian and kind of always from Chicago, so that's kind of in the blood. But I do like this concept that even the word of a soft landing, it's an oxymoron with the Fed hiking the most ever. I mean, I guess in the highest pace since 1980s. That's not looking for a soft landing. That's looking for a hard landing. And that's the kind of activity you take. That's a sledgehammer for a hard landing. And all the data is starting to tilt that way. I'll just end with this. Our Bloomberg economics team just pointed out that the probability of a recession according to their model in Putin's term is 100% based on the model. And, some people might say that's already started. So we can go from there. But that's macro. I'm sure we can dig in a lot more of the fun stuff with cryptos too.
Exactly. This is all how it all connects. But before we roll in straight, I want to ask you, first of all, and congratulate on your very honorable position of a senior commodity strategist for Bloomberg Intelligence. Like I said, you're a person who I truly look up to for, I don't know how long even, but if you were to run a little bit of a backend story, backstory to your success, how did it all happen for you to be this amazing strategist that you
happy
are?
to. Well, I never hurts to be a little lucky, but I started in the trading pits in Chicago. I grew up right by the Chicago Board of Trade, just south of there, like 25 miles, and that's where I got started and moved to New York in '93 and moved in Miami a year ago. So I've been around different firms. I started with Bloomberg 6 years ago, and yes, I do like very much what I do at Bloomberg Intelligence, because what I'm allowed to do here is write what I think without any bias. I've been buy side, I've been sell side, and I took a lot of flack this year for being bearish crude oil way too early, and now it's coming back. And a lot of times when you're at a sell side or buy side shop, it's certainly sell side. You can't always express what you think. And right now, I think it's somewhat my duty to warn people of the hurricane that's coming. Now, Jamie Dimon mentioned that a few months ago, but we're in a situation right now on a global basis that's very similar to 1929 in many ways, which is, I'm not trying to scaremonger. I'm just pointing out facts that I see in markets, and that's my goal. I'm always looking at least a year ahead, and that's the job. And it means you're going to get a lot wrong, but that's just what I do. But no bias.
No bias. So, Mike, year to date, of course, has been full of many surprises, at least to my side. And I myself, as a charter market technician, the only title holder from Poland, I've learned to set my perspective up with limited predictability of the market. We cannot predict what's market going to do in the next year for so well, at least. But we can draw conclusions on what's been happening and going on so far year to date. So what is your biggest surprise that you actually faced this year for the finance?
The thing I got wrong initially was the extent with the war. I mean, we didn't at the end this time last year we didn't expect a war. Although by this time last year I started focusing on, it was certainly maybe by November, December, on the risks of mean reversion in all markets. I've been calling this year the Great Reversion of 2022. Now, when I started pointing that out early in the year, I was considered somewhat of an idiot when I was too early on crude oil now and wrong. And now it's catching up to what I expected, that it's going to just continue to drop. And cryptos are following that. It's wrong. The thing I mainly missed was the high aggression from the number one Federal Reserve to hike rates, and then the rest of the markets to catch up. But it really fits into my narrative. The beginning of the year is don't fight the Fed. And that means cryptos too. Most notably the stock market. My main thing by now, I thought the bond market would start figuring out the recession and start doing very well, and it's still not. Bond yields are still rising. And the key thing I do have to point out is cryptos looks like they're bottoming, although we have to be careful if this hammer from the Fed keeps coming down and the stock market drops another 20%, which it could easily do, there's going to be problems in cryptos. But the key thing I'd like to end with is what's happened in the last almost, 4 months since Bitcoin first traded around 19,000 on the way down, and it's about that price now, is it's really stabilized, and everything else has started to continue to collapse. Like crude oil's collapsed. I'll mention why. I mentioned that a lot. And the amount of rate hikes priced in the market a year from now, back then, has increased 100 basis points. So it's almost a third have increased that much more as this sledgehammer pounds harder against risk assets as they're declining and getting very much beat up, like stock market down almost 25%, copper down almost 25%, and the Fed raising rate hike expectations. That is very unusual historically, and it's in my scenario that's akin to 1929, and it's global. So one thing I like to ask people is, where are we going to expect the recovery and growth to come from? It's certainly not going to be Europe. It's unlikely to be China. And as we know, the U.S. is tilting rapidly towards recession, as we mentioned earlier.
Yeah. I mean, it all makes sense, especially because, well, myself, being Polish in the roots, we are right next to this entire, hellfire that is going on the war side. And well, this definitely only accelerated this overall bear market, and then later ended up, pulling the world into the recession. But well, is this bear market, you think, mainly a fact of, overheated economy, or is it kind of like aligning with the midterm seasonality as we know it? Because we know that midterm years tend to perform worse than the others. What is this bear market, again, midterm seasonality, that you think may actually revert back in 2023?
To revert back in 2023, I looking at the key thing I see right now is what happened this year is just the only major asset class that's still up on the year, and we're, and towards the end, middle October, we're taping this on October 20th, are commodities. And they're starting to plunge. And that's what needs to, continuing to plunge. That needs to continue to take the Fed out of the picture, because the stock market's already down 25%. It's doing a major amount of tightening. Bond market's plunging. That's doing a significant amount of tightening. Housing's turned over, although that's very much lagging. Demand's turning over in almost every place as we've looked. The key thing that's the sore point right now in the macro are commodities, and crude oil is the one that sticks out. Right now, it's up about 15% in the year. Typically, it follows copper, which is down over 20% in the year. The key thing I'm looking forward to next year is what I think is we're going to tilt towards that significant enduring recession. We need to see at some point the Fed to stop tightening. The key point is they will never ease with the ease they have in the past. And I say never because they've learned the lesson of too much liquidity, and what that does for inflation, which means an enduring period of moribund performance and deflationary forces, I think, kicking in hard. And I'll point out the deflation when I look at the price of crude oil on the screen right now. It's $86. The first time it traded that price on the way up was in 2007. That's 15 years ago, the same price. Bitcoin didn't even exist then. And I was getting to point out, now we have technologies advancing so rapidly. Yes, we have this war, but we're going to move out from there, move beyond that. And it's, I think it's going to be the responsiveness, elasticity that usually kicks in, what keeps commodities lower for a good reason. And I fully expect it's going to be beneficial to Bitcoin in the long term. But right now, it's under that Fed sledgehammer.
Makes sense. Actually, I'm also looking at one of your tweets. I think the viewers will be able to see it in the screen right now. Well, and I quote, Bitcoin at $19,000 could gain upper hand versus 3,600 S&P 500, the lowest point Bitcoin price ever versus its 200-day moving average, right? So we have this mean reversion aspect to it. Well, if you could run a little bit of them, the viewers through what you mentioned in this tweet, how does it all stand positively or negatively for the near-term future?
Yeah, so this chart has been, so what you see on that chart is Bitcoin stopped, it reached 19,000 right about June. It had a bounce, but it's still at the same price, yet this S&P 500 is bounced to, and it's starting to actually tilt lower, tilt below its 200-day moving average, 200-week moving average. This is a weekly chart. The last time it dropped below its 200-week moving average from from above was in September 2008 when Lehman collapsed. I remember it well. And at the time, the Fed was easing aggressively. Bitcoin didn't even exist. And partly from that's when Bitcoin started. So Bitcoin was 0 and now it's 19,000. I think that's the kind of appreciation we maybe less so, but we should expect that type of appreciation to continue in the next 14 years, but at a much lower pace and lower volatility. But the key point is there is little to stop this pressure on the stock market when you see the most aggressive Fed tightening I've ever seen, despite the plunge in equities. Something has to break. Now it's breaking a lot. Like just today, I heard 4 German industrial metal companies just went under. They've been average age of over 100 years. We're seeing global recession risks kick in rapidly. The U.S. recession, our economics team, Anna Wong is my colleague in BI and Bloomberg Intelligence, and she points out the probability is 100% in the next few years of U.S. based on their models. And the key thing is I look forward is what stops this process of markets going lower. Now, what I've seen pointed out is Bitcoin's showing a bit of a divergent bottom, but again, this overwhelming macro force is you have to be careful with. I think that what's going to come out of this is we're going to get to that point. I don't know when it's going to happen, but I think it needs lower equities, commodities to really collapse, to kick in those deflationary forces, at least the forward-looking deflationary forces before the Fed starts to ignore the backward-looking deflationary measures a little bit and just eases up on the tightening. And that process, I see what's going to happen is Bitcoin will be transforming into more of a risk-off asset to act like gold and treasury bonds, which are all down a lot this year. That's just how bad it is. Everything's down. And just the key thing is look at where we were the last low in Bitcoin. The last time we reached a significant discount to its 200-week moving average, which we are, I think it's about 30 or so, 40%. That's the most ever, was 2008. I'm sorry, not 2018, 19. It bottomed around, it built the base around 5,000. It got as low as 3,000, but built a base around 5,000. It dipped really quickly there in March 2020. And here we are, 4x that price? 4 to 5x that price. That's indicative of, I see as an enduring bull market that's at a significant discount. And the key difference is for most other assets I watch, remember I'm a commodity guys, by code, demand is declining, and supply is declining, and demand and adoption are increasing. Just lately, the data we saw from MasterCard, the recommendation for the federal, the FASBA accounting standard to change their accounting standards, which would be more helpful. And there's just it seems to be a bit of a freight train of institutional adoption. Although at a slow pace. And one of the key things someday will be an ETF in the US, but I'm still looking forward to it someday with a proper ETF would be tracking an index of cryptos rather than just one like Bitcoin, like we have ETFs that track gold.
Makes sense. I mean, one thing I think, our viewers and listeners, overall would always try to understand is how there's this so-called decoupling, right? That people believe, that traders would tend to believe that there's this one simple rule that this is the moment that Bitcoin decouples, quote unquote, from stocks, and then it's never coming back, right? However, what I've noticed is that the markets tend to correlate stronger and less strongly at one point and the another. Once positively, the other time negatively. So it's kind of like wrapping itself in some forms of cycles. It's cyclical nature to it, right? So it's never one kind of like way to say, the correlation is going to inverse, and from now Bitcoin is going to trade immediately the same way that gold does, right? Because there's been lots of similarities, but also lots of differences the way that Bitcoin and gold would trade altogether. But having this layout so far for what you mentioned on the oil prices, on the Lehman collapse, on this overall adoption persisting for crypto, like how do you think crypto is going to come out of this recession? That is not a question mark anymore to it. What is it that you expect for the next year?
So the Bloomberg Galaxy Crypto Index, or most of the broad indices, have outperformed most other traditional assets on the way up, and then of course they're going down hard on the way down. So I expect Bitcoin and Ethereum in a broad index that measures the top cryptos to resume outperforming. But most notably, I expect Bitcoin to trade more like gold and long bonds and outperform most risk assets. either way, whether they continue to drop in a deflation environment or they resume the old school trend we've experienced for the last at least 15, it was like since 2009 was the bottom, that big bull market. The key thing I like to point out is gold is still significant. You ask your average 35-year-old or younger, they don't really care. And just a few years ago, Bitcoin was hovering at 1-to-1 versus gold, and the volatility was much higher. That's Bitcoin versus gold. Now it's hovering around 10-to-1 versus gold, and the volatility is declining versus almost every risk asset. That's the key thing. I mean the big picture. I look at annual volatility, 260 days. Then I don't see what stops that, because particularly with the world going digital rapidly, and old analog getting pushed aside, I think the way I've been describing gold and Bitcoin for a long time, you just can't hold gold anymore, invest in gold anymore without some Bitcoin in that space, unless you expect the world to stop advancing rapidly in terms of technological advances and going digital. That's unlikely. Bitcoin is the digital gold. And then the way I like to describe Ethereum, it makes possible one of the most significant things that a lot of people don't realize in cryptos, and that is the most widely traded cryptos are dollar tokens, the dollar. I mean, the base layer for all cryptos is the buck, the dollar. Now, Americans are starting to figure this out, and that's part of the reason I fully expect legislation to be favorable, and potentially because China's pushed back, partly because they have to. Their autocratic system does not allow the free flow of capital and the use of things like cryptos, at least on a global basis. But Ethereum's making this possible. Now, most of these are Ethereum tokens, but it's making this new technology possible. And I view it akin to futures. I started in the futures trading pit in Chicago, and I remember the guys in New York used to get upset. Well, the futures are moving the markets. That was treasuries, and they do more so than ever. And ETFs. What have ETFs done for financialization and the ease of investing and stuff? And that's the reason I like to mention MasterCard and Visa. I mean, they're adopting crypto dollars. Stable coins, some people call them. I like to call them what they really are. They're mostly dollars, stable coins that track the dollar. And then there's these issues with, on a global basis, of current countries like China trying to launch central bank digital currencies, CBDC, because they have to. The world doesn't want their currency. And the US dollar doesn't have to do that, because just have to properly regulate stable coins, and boom, it's done. And that's a key thing I like to point out. This has happened organically. This is why this is so strong for the US and for the dollar. This space, that is one of the most unique examples of global free market capitalism I've ever seen, where it trades 24/7, particularly Bitcoin, no one's responsibility, no one's liability, has gone for the dollar as its base layer. And that's for the US to mess up, and US typically doesn't mess up things like that.
Gotcha. Makes sense. Makes sense. I would be very, very honestly curious to hear, of course, over what you mentioned so far. It's good to have some expectations, right? People love some mental anchors in terms of like attaching to specific numbers. Of course, people would always search for this invisible targets or this chart pattern to break up, and then rally for a specific amount of distance on the price chart. However, it's very difficult, like I said, to predict the future. It's almost impossible to keep predicting the future well. But if you were to anchor your mind somehow and then specific numbers, did you have any specific numbers for in the Bitcoin chart marked that you would pay the most attention to, so far or the next year?
Yeah, we can add a lot of things. I think I've been quoted on this, and I stick with it. In the big picture, I don't see what stops Bitcoin getting to 100,000. It potentially is building a base now in terms of the macro, just by watching and extrapolating forward the supply and demand and adoption trends. The total market cap of Bitcoin is quite small versus of all cryptos. It's less than 1% of global equities, and global equities have dropped $30 trillion this year. Maybe a little more based on what's traded on exchange and the data I have in the Bloomberg terminal. The amount that's coming out of cryptos is about $1 trillion, maybe a little more. It's some rounding error. But the amount of time, effort, and resources and interest I see in this space is is quite significant compared to most other assets. Partly because I think what people get, yes, a lot of it's hype, a lot of it's speculation. Things like Dogecoin and Shiba Inu were just silly, stupid. And Terra Luna, it's like, thank God we took that stuff out. Unfortunately, people had to get hurt. But a lot of us remember that from the bubble burst in 2000 to 2002 in terms of internet stocks. This is, to me, just the next step forward. But going backwards is unlikely. To me, that this is just part of the global network. Now, this technology is too significant. It does too many things to help make the world a better place. And the key way I like to describe it is the quote from Wences Caceres. He is a internet entrepreneur from Argentina. That, for Americans, money is like water is to a fish. For the rest of the world, it's not. And I just hear every day, and from my colleagues in Asia, and certainly I'm in Miami now, people here get melting currencies, and people in China and a lot of Asian countries want to have access to the dollar, and they can get it through the buck, or Bitcoin's part of that.
Got you. It makes sense. It makes sense. I mean, but if you were to kind of like, again, call it predict out of what I'd love to name it, what the potential reversal, is going to align with, because I know you're observing the crude oil, right? I know you're observing commodities. I know you're observing Bitcoin next to it and within this entire system. Is there any specific commodity side reversal that you would expect for Bitcoin to follow through?
Yeah. So the key thing I've been watching, the number one commodity that matters this year is crude oil. This pump we had with the war was the most significant pump on crude oil futures versus this 100-week moving average ever. Crude oil futures have been around since 82, 83. I mean, it surpassed the velocity of the rally since when Saddam Hussein invaded Kuwait. I was in the trading pits there. Crude oil went from 20 to 40. And then back to 20 and stayed below that level for 14 years. So what this did is significant because it tilted that world at a beginning year where we were thinking maybe the Fed be tightening 25 basis points at each meeting and eventually things would calm down. It added rocket fuel to that because inflation picked up for other reasons too. The Fed started tightening more. Now every central bank in the world is trying to catch up. The dollar's taking off. Other currencies are collapsing. I mean, what's happening in England this year is significant. There's other reasons. What's happening with the Japanese yen down 20%, the Chinese yuan down 15%, the euro down about 15%. Is the world breaking? And part of that is what happened with the Fed tightening so fast. So and a key thing that they're doing too, and we have to remember, is all the biggest dumps in history, busts, have come on the back of massively expanding liquidity that goes away. And that's exactly what happened. We had the biggest pump in monetary supply, in U.S. monetary supply ever, up to this peak in 2021. And year over year it was around 26%. Now, we have to not just rip into the Fed here, because remember, it was only about a year and a half ago we got vaccines. There was a major risk that we had a significant plague, and the world looked like it was going to go to a pretty dark period. Now we've got through that, we've recovered at least, and now we have to take away that liquidity. And that to me is what's happening. Just I think the Fed's not seeing a lot of the stuff that some of our people are seeing, that this is going down faster than things happened in 2008. I see that in things like unleaded gas demand in the U.S. dropping at a higher velocity, with the home housing market. The steepening curve. There's just so much of this reversion stuff that's quite significant. And but that's the key thing I still look at as a sore thumb on the screens right now. Crude oil still up about 15% in the year. Before, to really get out of this tightening period from the Fed, which really focused on backward work and inflation data, we need to probably see a plunge in crude oil, the world's most significant commodity. Now we've seen that copper. It does what it normally does. It goes back to 50 or even 40. That's what normally happens in global recessions, particularly in U.S. recessions. That's not profound to say that, because typically it gets about 50% below its 200-week moving average, and right now it's still about 35% above that mean. So to me, it's a key thing I'm looking for. But there's also other things can happen. The key thing we need to look forward to for Bitcoin to bottom, I think, is an end to this sledgehammer from the Fed. And I just come up with reasons that might happen. Now, a lower plateau will do it, much lower in the stock market, or I think the more likely thing was commodities collapsing.
Makes sense. Makes sense. Well, of course, there are so many other questions that I have in my mind, but I definitely want to respect your time, and I already appreciate your generosity of time, like I mentioned. However, I would say that we have this typical custom to give to our speakers this chance to share one final golden tip to leave our viewers and listeners with. What would that be from Mike McGlone?
Tip, golden tip. Oh boy. I think the key thing I like to point out is what's not to underestimate the powers of revision and history. And what's we're in the midst right now is the greatest reversion of the greatest pump and money supply ever. It's not going to be easy getting out of that unless something's different. That would be unlikely. And I think what's going to happen with this, as far as the tip is, the most important thing is to remain careful and solvent and being able to scoop up assets when they really drop a lot. And it'd be wonderful if the bottom's in, but I've just never seen this where markets down this much, this hard, and the Fed's still tightening more. So I'm worried about that 1929 type scenario, which what it did then is it really separated a lot of the excesses of excess and put assets back into some of the rightful owners and really hurt a lot of people. And I think when the early days of pain, crypto is a good example of that. Now, we've seen the people getting hammered. A lot of that was for play money, for some people, serious money. Now it's turning towards serious money to more regular folks, 401ks, home housing values, and staying gainfully employed and not taking too much risk and being solvent when things get cheap, which I think they're going to get much cheaper, is I think the best way to handle it.
Mm. Yes, this is something that I read about in the book, Mike. I mean, the deflationary nightmare is what Fed would try to avoid at any cost, at any time. However, it does seem that at the same time we're actually falling right into this very period. So, having so much already said from your side, Mike, I want to appreciate the time, the wealth of knowledge that you brought to the show. The Nest Show podcast is supposed to deliver value to the trader related community, so I appreciate your insights. And before we go, I definitely want to recommend to everybody to go and jump on Twitter. Make sure you hit the follow button and set your notification marks. That's what I've done for Mike McGlone. And the handle is Mike McGlone 11. Mike McGlone 11, senior commodity strategist of Bloomberg Intelligence, has been today's guest for the Nest Show podcast. Mike, thank you so much for coming over.
Thank you very much for having me. Looking forward to the next time.
Let's set it the next time. Thank you. And all to the next guys.